Hello everybody, it's me the Boss Hog, and today we're going to have a look at my buys, sells and dividend for the last week. Pretty bruising week. This meme felt broadly appropriate, and then I've stuck on some of my conviction positions, which are red to various degrees and moving in various directions. Anyway, let's have a look at what's happening. Alright, so I guess in terms of performance, we'll start with the top left graph. I'm fairly sure a lot of people had similar weeks. It was really quite rough in the middle of it. My only disappointment is that I still finished a week down, very modestly in the scheme of things, and within that there were some pretty violent movements depending on the day. But honestly, I'm kind of grateful for a flat week. It does sort of test you a little bit, and although I sort of like to think of myself as resilient, it does suck to keep seeing red days and red weeks. So Friday just felt like a nice tonic, just a little bit to soothe the recent pains, and hopefully everyone else is feeling the same. And yeah, we just have to, I think, trust the process. So although I am trusting the process and still doing what I think should be doing, it doesn't feel great in the short term, right? Like, let's not kid ourselves. The only sort of bright spot for me is that, again, I know how this stuff works in the long run, and I feel like I'm buying some good companies at below prices I would have paid for them previously. So that's how I'm sort of dealing with it. No new capital added this week. That was expected. I mentioned last week I was 3 weeks ahead, so after this week I'm now 2 weeks ahead. That's really just because in the past I was averaging in every week. Now, because the market's going downwards, I'm just putting a lot of money in the first week of the month as soon as I get paid, basically. So hence that. Next up, so another week where honestly trading felt really good. It is my third or fourth week in a row where at least short-term measures. So I sort of have a look at what happened to the stocks that I sold, the stocks that I bought, and basically the net difference is about 3% on a relatively big number. So that's worth about £300. And plus the shares that I've been buying are, in my opinion, better. They're safer. They're longer-term holdings. You'll see in a second, like the shares that I've sold. Especially the main contribution this week was always meant to be a kind of long-term trade, but it didn't have a dividend. It's basically a recovery stock, and I decided to exit for various reasons that we'll touch on too. So that didn't have a dividend at all because it was a recovery stock, and so I've also got that additional safety of a sort of blended 5% yield on the buys that I've been buying as well. So again, I feel very pleased actually with my recent trading to try and minimize some of the damage. And last but not least, 2 dividends this week. I was expecting, especially the Phoenix one, it was so big I've been like tracking it almost. That's my largest dividend to date. Feels really good, and actually since this buy I've added about 70% to my position, so the next dividend would be a big one. Phoenix pays twice a year, but fairly unusually for UK stocks actually. Although UK stocks often pay twice a year, most of the time they pay different amounts. Phoenix actually has a 50-50 split in its final and interim dividends. So I will get a similar percentage in a couple of months. But again, I've significantly increased my holdings, so I expect it to be closer to 500, or about maybe even north of 500 actually, when I get the next dividend. So that will feel, again, really great. Anyway, let's have a look at my buys. All right, so I'm super happy with my buys this week, honestly. I'm going to start with Huntsman. For anyone who's been following me, you may be aware at one stage this was my largest holding last year. I was buying in for about $24 and sold out around $34. And to me, it felt like at the time it had reached fair value. I actually started selling out around $32 and finished at about $35. So yeah, and at the time I had no regrets really, but I do really like the company, and I then saw it go up to about $40 and just was like, damn, I've sold too early. Story of my first year of investing, never mind. So I've still made over £4,500 on this stock in the past profit. We're now back into Huntsman. I saw it, I was tracking it for a few weeks as it gradually came back down, and I pulled the trigger under $34. My average here is $33.68. And honestly, I think this is a pretty good price. Like, maybe there are better bargains out there, but it kind of reminds me of like a great company for a fair price kind of viewpoint. Like, Huntsman has more or less completed its move from sort of having a lot of low margin but volumes into less margin but better quality. and it's something that they stress on the earnings call. So I already was pretty up to date with Huntsman, just sort of 2 or 3 quarters behind, but I listened to the latest results, and since I left Huntsman, in my opinion, it's become a better business. They have a new site going online imminently, which will feed into their H2 numbers. And honestly, although 6 to 9 months ago I was saying that fair prices in the low 30s, now I think actually it should be in the high 30s. It's only an 8 billion market cap, despite the improvement. And it was very interesting to me, the earnings call. Like, one of the questions was, are you interested in adding any more greenfield sites, right? Any new sites? And by the time they were sort of done with the calculation, the CFO was more or less of the opinion that it just, like, the stock is so cheap at the moment, it would make much more sense to, basically buy back 20% of the shares instead of investing in a greenfield site, which to me was kind of a good sign of a company really thinking about how it should meet shareholder value. So it was a good presentation. It's the business that I remember, if not improved. So yeah, I'm really happy to be back into Huntsman. I may well look to add to this position. And yeah, I'm just really happy. I think it's a really great industrial. I think it flies under the radar because it's gone on this journey where its revenue has declined, but the business just looks in good shape at the moment, and it's moving into all the right areas. So again, I just like what I'm seeing still, and especially at this price point, I think it's a very fair buy. Next up, we got PHNX. So this is it was historically a life assurance company, but it's since been doing a lot of what it terms wealth management, but really that's like retirement planning, pensions, that sort of stuff. It's gradually been expanding, and it's a very sort of like one of those companies that's never going to set the world on fire. Like, even the way that they hedge is extremely risk adverse. Until very recently, a lot of their dividend growth was from acquisitions, although now it's starting to see some organic growth as well. And historically, they operated in part of the financial sector, in insurance specifically, that was very low margin and required high volume. But basically, they've now got to the stage where not only are they the best in class in that sphere, but they have the volume and to really sort of drive those efficiencies, and they're sort of using their heritage business, their legacy stuff basically, to go into their more their higher margin wealth management stuff. And actually, I had a look through their recent investor day, and only 40% of their business is now heritage, and 60%, sorry, of their earnings, 40% of their earnings are heritage, and 60% are basically wealth management, slightly above actually. And they've got tons of cash on hand. They're so well capitalized, extremely high dividend, even though they have extremely high dividend cover to pay it. And this is a business which is also undergoing a lot of like IT transformation. They're finally getting around to like aggregating all the different platforms that they've been purchasing over the years. And it's just a sensible, well-run, well-diversified business, which again is moving in the right area. So for me, being able to materially increase my holding here, over the last few weeks, I've gone from 1,200 odd shares to now 2,000. When I bought these, I obviously had 1,500. So a significant increase in my stakes here, and I brought down my average to 620, which means, as things stand at the moment, I'm only just red on this stock, which again doesn't include the dividends or anything else. So I feel really comfortable with this as a long-term holding. Next up, some new positions. So I've never owned ASML or Micron before. Basically, I was looking around for some semiconductor stocks. I do have a very large position in AMKR at the moment, which, by the way, 7 PE for, again, another improving smallish business is totally worth your attention, in my opinion. But I decided to sort of start almost building my own semiconductor ETF. I sort of wanted an additional company, but I couldn't make up my mind. But anyway, I'm happy with these two. ASML for basically building the foundation for particularly Intel's chips, but that they produce the scaffolding effectively. And Micron is sort of a play on storage. I think that's going to be important in the future. Not super expensive, likewise. In fact, quite cheap, I would say. ASML is a bit expensive, but I think worth it for obvious reasons. So I like these kind of plays. I got medium-sized positions in both of them. I'm pretty happy, to be honest with you, with both positions. And actually, I bought 15 of the Micron from one of the positions I sold, and then 5 of them basically were straight from the PHNX dividend. So again, it's good to see that already doing its thing. So again, I like both of these companies. I hope to familiarize myself with them a bit more. But for now, I'm happy with the knowledge. And by the way, shout out to the people in Discord who recommended these. Micron I kind of had on my radar. ASML I didn't. And these were the two that I decided to go with after some other suggestions as well. And lastly here, I just wanted to talk about Aviva. I skipped over Gamma just because I've spoken about it tons before and continue to think that's a bargain, by the way. But Aviva is an interesting one because originally I expected to be sold out of Aviva by now, but actually I decided that under £4, and I know here it says £4.01, but that's because the average here includes stamp duty in the UK, so that's 0.5% on most stocks. But yeah, my average here is about £4 anyway. They're about to do a special dividend from the work they've been doing over the last couple of years, basically simplifying their business and improving it. And they're also doing a share consolidation. And all that aside means that I think I am about to get a £1 special dividend. The share consolidation is not too gross. And basically, as a combination of the share consolidation and things that they've committed to already in terms of their dividend for next year, as a result of that, just running the numbers, you're basically looking at a 15% dividend rise next year. So considering it already has a very solid dividend anyway, outside of the special, this to me is sort of now, I'm going to keep this for a year and then sell it, basically. Aviva for me was all about the turnaround. I have PHNX and I also have Legal in General. Two very good UK insurers. Aviva I still think is a perfectly reasonable buy, by the way. It's just my reason for owning Aviva is coming to an end. I'm going to enjoy the tail end of that work. Turnaround is complete. Good job, CEO. Let's all pat ourselves on the back and reward our shareholders for their patience, basically. So I added here 100 shares. I had 300 shares before, so again, a reasonably big increase in my holding. And yeah, so in a month or two's time, I'll get a £400 special dividend, and we'll decide what to do with it then. I may well put it straight back into Aviva, but we'll see what the market's doing then to decide. So those are all the buys I want to talk about. If I haven't spoken about anything on this list, just drop me a comment and I'll do my best to answer. Let's do the sells. All right, so my sells. It's a short list, but especially the first one here, I just want to spend a minute talking about. So I was into National Express reasonably early. When I first started, I had a very high average, but I followed it down until I ended up with an average not far above about 210, I think it was, 214 maybe. Now, I don't think this is the best price, to be clear. I still think National Express is somewhere around the 300p in terms of its value, so arguably this is still a buy, if you're happy with that return and the risks and everything else. I sold out for a couple of reasons here. First of all, I was happy to profit take. It was one of my few greens over the last week, and redeploy. But I also wanted to redeploy because, again, this is meant to have been a slightly longer term hold for me, admittedly, but was never meant to be like a forever stock. It was really meant to be, kind of a 1 to 3 year journey. So I still believe in that journey. I still think they're well run and smart and everything else, by the way, good strategy, all the rest of it. I still think it's a decent investment with some risk. But for me, I'm in the process of de-risking my portfolio. I got really badly stung by some Russian miners. I'm sitting on unrealized but very material losses there. Also, as well, I mentioned last week that my wife has accepted a new job with a private equity company, and basically to avoid conflicts of interest, I have to sort of give advanced trading information, like what I'm going to be doing. So it just means I'm much less able to respond and do those kind of value investing and value trades that I've done, and to me, National Express will be impacted if there was a further lockdown, if oil price remains high, would also impact. And to be honest with you, I had another look at their numbers, and there is at the moment a bit of a divergence between their revenue and their earnings recovery. And I do think we're going to see some pressure on earnings with sort of wage growth. They're trying to transition to an EV fleet as well. Then you've got oil. And I just although I think that they will overcome those challenges, they haven't paid a dividend. I'm moving into dividend stocks that I'm just going to be able to drip. I've already cleared it with my wife's future employer. The drips are fine, so I can just reinvest in the same company without having to give notification. So again, I just felt like it was a good chance for me to kind of move away from this, what was meant to be a slightly longer term trade. but into solid companies, you know, and this basically went into Phoenix, Huntsman, Micron, and ASML. So again, I really like all of those between sort of growth and dividend and better safety and really more scalable industries, I would argue. And we go from there. So no regrets. I eventually worked this out that my blended profit was 19%. To be honest, considering I was like buying into this in the low twos and think it's worth, you know, £3, maybe slightly higher actually. It looks a little bit short, but again, I think it takes several years to realize, and it might not be smooth sailing. So I'm fine with this exit, even if it means that I'm keeping up a somewhat deserved reputation in Discord for having no loyalty to stocks that I've previously spoken about. This was my largest holding at one stage. It was about 23% of my portfolio, and now it's 0. So that's just the way it goes, I suppose. And next up, Hollywood Bowl. I decided to sell some of my position. This was really just to average into Gamma and Aviva and a couple of others as well. I was actually a bit annoyed when the sale price went through, just because actually I clicked on it at like 255, which I thought was okay. Again, in the market, I have a 290 price here for this company, by the way. So it was really like opportunistic, and actually I'm quite happy to buy into Hollywood Bowl under 240. So it's just a case of like everything else is falling, and again I think Gamma at the moment is so ridiculously underpriced that that's like 50% undervalued in my opinion. So I made that move, but actually I wouldn't have sold this for 243. I wanted to sell it for 255, and again I suppose this is the importance when especially when you're dealing with smaller traded stocks, where you know there can be some volatility in the pricing. I was a bit frustrated when I saw the sell price. So I mean, it's like 10p across 500 shares, so it's only 50 quid, but it felt like the most annoying 50 quid ever. Again, I suppose that's why we should put limit prices on these things rather than just letting the market decide, and presumably it wouldn't have gone through. So those are my sales this week. Without further ado, let's have a look at the top 10, which is very different, actually, not just National Express, but lots of movement elsewhere. All right, so in my top 10, change in position here. It looks a bit weird just because of the way that National Express fell out entirely and a few things rose. We're going to start with Gamma. No new news here, but again, it continues its seemingly unstoppable slide. Again, I bought, so we will average down and enjoy this journey. It has now become my largest holding, which was expected this year. Just happened slightly earlier because of the National Express sale. The big mover here is Phoenix, up 3 places. You know, again, I added a third to my position, and it's been on the up this week. You can see they're rising over 7%. There was a couple of Motley Fool articles here, just highlighting things that are really sort of known, not sort of anything revolutionary. I'll leave the links in the comments, in the description for this video. But you know, highlighting the dividend, the safety, and the reliability basically as a business, which I completely agree with. Games Workshop had a Stockopedia article, just pointed out the dividend. I found it a bit of a weird article because it was all about the dividend, but like Games Workshop themselves kind of don't really class themselves as a dividend growth company. They talk about truly surplus cash. They basically pay as and when they feel like it. However, they are fairly rare for UK companies, especially non-commodity UK companies, in that they pay quarterly dividends. So that's quite nice, I suppose. And I mean, this article is right. Like, it's over 3% yield at the moment, so it's no joke. They've become a dividend, decent yield, whether they would like it or not, as a result of their declining share price. There was also a Motley Fool article arguing it's overvalued. I think that as well. That's why it's so high on my list. And you know, I'm due a dividend from this next week. It actually got paid today, but my broker hasn't processed it yet. But yeah, so this will be going straight back into Games Workshop, I would imagine. Next up, we've got AMKR here. So there was an interesting article actually on Stock News, and for anyone interested in semi-sphere, again, the link will be there. But they sort of highlighted 3 stocks in the semi-sphere, including TSM and Intel, for various reasons. Their main argument here was that AMKR was effectively just cheap, but is transitioning. It was adding value. Their expected EPS this year is 285. That's fractionally lower than mine, but yeah, I have a similar number here as well. The market reacted a bit weirdly to AMKR's Q2 update. Sorry for the noise in the background. the Q2 update, because although the results, the Q1 results, sorry, were really good, record breaking even, Q2 was kind of similar to last year in light of the Shanghai lockdown, so everyone was just focusing on the Q2. But if you assume that Q3 and Q4 will show similar growth to Q1, this is a stock which is trading on a 7 PE and under a 6 forward PE. And again, it's a quality company making money and moving in the right direction. So fine. Genius here. So this is one of my, I think my only remaining SPAC. It was originally DMYD 3, I think. They have produced decent earnings, revenue well ahead of expectations, well, 10% ahead of expectations, but up 90%. Earnings 42% ahead of expectations. They're still slightly loss-making for the quarter, but they reaffirmed their guidance for this year to be £15 million profitable, which is good. I have had worries in the past about Genius. I probably did get overly excited in the past. But basically here, this isn't like an out-of-the-box SPAC. It's basically like using a European already profitable operation to finance a not yet profitable US operation, right? So they're basically doing that to scale. It's a proven business and technology. They're just moving it to a different continent. And especially from 2023, this becomes a very profitable business. Again, I probably got into this a little bit too early, if I'm honest. I have a buy price in the $8, so at 3.30, I'm definitely very red on this. But still, after the investor day in January, I totally get the business. It's really moving in the right direction. Its marketing content assistance, basically, and its technology is really ramping up quickly, kind of close to a 200% growth year on year. Really flying. Everything else was looking good as well, basically. So I was actually very happy with the earnings call. It took a little while for the market to wake up because it was also, I think on Thursday, the earnings call, when obviously the market was still suffering. It had a good Friday, and again, I still think there's value to be had here if you have a good risk tolerance and this is your thing. Yeah. No movement on on Hollywood or Huntsman, and again, I've already spoken about Huntsman in the earnings call that I caught up on. Huntington here is interesting. So this is a Midwestern regional bank, but it's quite big. It's in the middle of the S&P 500 in terms of size. Zach's classed it as being a great dividend stock, which, yeah, actually at current prices, it's above 5%. I've spoken beforehand about the fact that this is quite hard for me to categorize the stock because actually it's kind of a bit of everything. You get a really good existing dividend, you get pretty solid dividend growth as well. EPS growth is also really looking good. And I think for a company like this, it's important to look at EPS growth, like they are expanding, they are buying. So, you need to have a look at how that's being translated into your earnings per share. But for me, again, I like what I'm seeing. The earning percent here, the EPS up 30% year on year. I was kind of surprised after what was a relatively positive article that they just labeled it as a hold. I think there are some concerns with financials around the wider economic health, but for me, I think this company, although it's regional, it's across a fair number of states and both consumer and business. It also scores really highly on the sort of engagement and the more modern apps and stuff that you want to be seeing from potentially a stuffy old bank. Not that Huntington is, by the way. So I kind of get those concerns, but actually I think banks would be obviously a big beneficiary from any base rate increases. And I think the worries are overdone at the moment. So this for me is a good one to lock away because it's growing, it's got a good dividend already, it's got good dividend growth as well. Just kind of ticks a lot of boxes basically. So we'll see. They should be completing the acquisition of a wealth management arm that they are buying. So, having just digested a very transformational buy last year, they're now buying a less transformational, but still a big deal company to basically, keep on expanding their offering in terms of what they do. So again, I like this company at the moment. I think this company actually under 14 is a buy. So, needless to say, under 13 is a very clear buy for me. And I have a target price here of 17.20. So again, I'm very happy with the 5% plus any potential upside that we have. And again, I would like to be adding more Huntington as we go. Last one. Oh, actually, I do still want to talk about legal in general, but let's talk about Disney first. So the results were kind of mixed. And for me, I was actually a bit disappointed. Obviously, what put a floor under the sales price was the good sub growth, especially after Netflix's disaster. Disney Plus still grows, and by the way, let's not overlook things like Hulu and ESPN as well. Like those sub growths were arguably even more impressive, I would say. However, the EPS was less impressive, and especially for me, like I don't mind going on record as saying like I have an EPS for Disney for this year at $6. And that's way higher than consensus expectations of 4. And after Q1, where the expectations got smashed by about 70%, I felt pretty smug with myself. But here the EPS was basically a meet. But it wasn't really the ramping up that I was expecting. And to be honest, at least part of that is because some of the costs are starting to come through with delivering this content, right? And Disney are having to invest to get these sub numbers. So I still think in the long term, like Disney has such a huge catalog already, right? It's been around for such a long time, has so much IP, and it's continuously building its IP as well, right? That's clear. So in the long term, this is just going to be great. It still has that, to me, fairly obvious and inherent scaling. It still has such a brand, incredible brand power, and the ability to sort of use one part of its business to basically sell products elsewhere, I think is amazing. But I did expect to see a bit more, to be honest. Parks are recovering, that much is clear, and moving in the right direction. But I think their costs are starting to feed through, and that ultimately is having an impact on overall earnings, right? So I'm still optimistic on Disney. It's to me at least, it feels like such a safe long-term hold that it doesn't matter too much in the short term. However, if the EPS is only $4 this year, I would say paying, a P of in the high 20s isn't really that great, considering, you pick up Google or many other companies for less than that, right? Google at the moment is like an 18. AMKR I just said was a 7. Disney starts to look expensive if you believe that the EPS is closer to $4 than 6. So obviously here, it wasn't like a car crash. It was just, for me personally, a little bit disappointing. And I probably won't be buying any more Disney shares in the short term until we see Q3 and what that does. So I'm happy actually with my position in Disney at the moment. I have 30 shares in it. It's clearly here my 9th largest company. And again, I still believe in it long term, even if I might be forced to concede that I've overpaid for it. I still think in the long term it's going to be a winner. So there is that safety net here. I think Q3 will be a better indication of whether we're going to make that leap from what's effectively a $2.11, I think, H1, and what the overall H2 is going to look like. But right now, if I was proud of myself in Q1 for beating analyst expectations, I feel like analysts definitely won round 2, so we'll have to see how it moves in future rounds. But that's how it stands at the moment. And I just want to touch here on legal in general. No news, but actually this is the first time it's made it into the top 10. Now the Discord I'm in, which is Paul Briscoe's Discord, loves legal in general. There's lots of hype for it. We have a huge number of shares between us, actually. Tens of thousands. I can't actually remember the exact number, but I want to say tens of thousands. There's lots of advocates in there. It's an incredibly well diversified insurance company, but it's way more than that. It's a pretty broad financial. It's actually, I was reading, the 2nd largest asset manager in the UK after BlackRock. It has hundreds of billions under management. And again, if you look at its efficiency measures, it scores really highly. I think it's a real quality company. I've been adding to my shares, underneath 250, which feels really good. And again, it's got a very decent dividend yield as well, and it's just a very good long-term business. I would argue that if you were to pick any UK company, you could only pick one UK company, you had to hold it forever. Legal in general should be in that conversation. It is kind of the T Rowe or the JP Morgan, or kind of one of those that gives you, it's almost like a proxy. I just think it should be in that kind of conversation. So for me, being able to pick up this company and build a stake, now apparently making it number 10, feels really good. This is probably one of my forever holds. We'll see, because I'll probably sell it next year. It'll be like National Express all over again, right? But I feel really good about being an advocate for this company as well. And again, it deserves some love. I think it's good, despite the year-on-year change, and obviously the month-on-month change here. I think the financials likewise are getting a bit beaten up at the moment, but insurers have a lot of going for them, and it's actually one of my favorite areas to invest in. So I'd like to actually pick up potentially some more UK insurers in the future, but I haven't had a chance to do some reading, and they can be quite different. So you can't just apply a broad brush across the industry, unfortunately. So lots of changes this week. NEX obviously fell out of my top 10 because I sold it. Salesforce no longer a top 10. That's sort of a combination of a good week from LGen and a disappointing week from CRM. I bought a little bit as well, so that sort of explains that. T-Row is still, I think, like number 12. It's actually like I have a top 14, which is clearly ahead of everyone else. There's not much between LGen and whoever is in 14th, maybe Redrow. It's pretty close up there at the moment. So the number 10 here might change. We'll see how it goes over the next month or two, but it's pretty close in the number 10 spot at the moment. So anyway, that's my buy sells, everything that's been happening this week. It's been a pretty wild week. I'm actually relatively happy to have finished on a high. Top 10 looks very different as well this week, which is cool, and lots to talk about. Half an hour of your time, so thank you everyone who stuck with it, especially to the end. I've been the Boss Hog. Good luck with your investing, and bye for now. Cheers.